All right. Hello, good morning. Am I audible to you all?
Yes.
Okay. Okay. Today we are going to discuss about auditor's responsibilities and the objective. Okay. So let's discuss. Right. ISA 200 talks about the overall objectives of the independent auditor and the conduct of an audit in accordance with the international standards of accounting, which means this is the standard, international standard, which list out the overall objective of the independent auditors, right? As per IAS 200, there are three objectives. The auditor's overall objectives are to obtain the reasonable assurance. We know the types of assurance we have already discussed, right? So in audit, it is the overall objective as an auditor to provide the reasonable assurance, right? How many types of assurance are there? Can anyone tell? How many types of assurance are there? Or else,
Absolute assurance, reasonable assurance.
sorry?
Absolute assurance, reasonable assurance.
No, 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 no. In audit, there are two types of assurance, that's right. But one is limited assurance, the other one is the reasonable assurance. Okay. We can't provide absolute assurance in an assurance engagement. Okay. Is that clear, Manas? Right. So we need to provide the reasonable assurance about whether the financial statement as a whole are free from material misstatement, whether due to fraud or error. That is the reasonable assurance. That's the first objective. The second one is enable the auditor to express an opinion, right? Which means we should evaluate whether management has presented the financial statement in accordance with the applicable financial reporting framework or not, right? Because we know if it is Sri Lanka, then financial statement must be prepared in accordance with SLFRS and LKS, right? If they fail to comply with these standards, then we will have to modify our qualification, right? That is the second objective. Finally, report on the financial statement, which means we know once we complete our audit, we must communicate the findings, right? Finding in the sense it can be any control weaknesses, or else there may be some material misstatements also. So such kind of things we must communicate with the management as well as those who charge with governance, right? So these are the overall objectives of an auditor, right? Is that clear? No responses, right? Okay, right. Here is the next question. Why reasonable assurance, not absolute assurance? Why we can't provide the absolute assurance, right? Because there are some inherent limitations which prevent us from providing an absolute assurance, right? There are four inherent limitations. One is nature of audit evidence, which means when we are conducting an audit, we normally test the samples, right? Not the entire population. As well as once we test we can test any kind of evidence, but we can't say that evidence is conclusive. The certainty is in question, right? Also, when we evaluating the audit evidences, we have to use our professional judgment, right? So it can be vary auditor to auditor, right? That's why we can't provide the absolute assurance. That is the one limitation, because we only test the sample, not the entire population, not examining the 100% of the transactions. That is the first limitation, right? Second one, effectiveness of internal control, right? You know, in most of the organization, normally in private limiteds, right? I'm talking about private limited now. Normally in private limited, they don't care about the internal controls, right? So if as an auditor, if you are going to audit such kind of company, you won't be able to test the controls, internal controls. Then what will happen? right? There will be a risk called control risk. Control risk, right? So because of these control weaknesses, it will lead the companies or the employees to commit frauds easily, right? Because there is an opportunity to commit the fraud, right? Also, control relies on human implementation and judgment, right? So all the controls are designed and implemented by the management. Those are human beings. Therefore, some mistakes can happen. So it prevents us from providing an absolute assurance, right? Also, even some companies may have effective internal controls, right? They may have effective internal controls, but if employees colluded, then they can easily commit a fraud. Let's assume there is a company, they have segregated their duties, right, among the employees, right? Let's say, let's think about the purchase process. Purchase, right? Once we purchased, we should pay, no? We should pay the supplier. At the time of payment, they have the control. We need to raise a payment voucher. It must be prepared by a lower level employee, and also it must be checked by another person. Finally, must get the approval from the higher official. This is the normal control they have in order to make a payment, right? So there should be a preparer. Then a senior person should check whether those amounts are in line with the supporting documents or not. Once he sign, then that payment voucher must be forwarded to the authorized person who approve this payment. The person who approve this payment, right? Okay, these are the controls. So it will reduce the errors. Obvious now, because there are three persons involved in making the payment, right? But let's assume if they colluded, which means these three persons, right? These three persons, let's assume they become friends throughout the years because they are in the same role for few more than 1 or 2 years. Now they become more closer. Now they plan to commit a fraud. Planning. They plan to commit a fraud by communicating with each other, right? In such moment, even if that company has an internal control, effective internal control, they can commit a fraud, right? So that is the collusion. For if we look at the NDB fraud, they also commit the fraud through this collusion, right? So it doesn't matter if we have the effective internal control or not. We can only provide the reasonable assurance, not absolute assurance, because in future some things can be happen, right? As well as the higher officials, leaders, or the managers are the persons who implement these internal controls now. So they can easily break those rules and override those controls, right? If we are the rule creators, we can be the rule breakers also, right? That is the normal assumptions. So management can easily override the internal controls. So based on these things, we can't provide the absolute assurance, right? It will lead to misstatements. The third one, inherent limitations of accounting. When we are preparing the financial statements, normally as an accountant, it requires to use our estimates, judgments, and assumptions, right? Can anyone tell me for what purpose we use the estimates when we are preparing the financial statements? For what purpose? What is the purpose of using estimates? Can anyone tell? Give me an example where we use the estimates. Anyone? Hello? Are you there? Manas? Am I audible? Hello?
Sir,
Okay.
For any event plan,
Sorry?
for any event plans, we use the
Okay, for
estimates.
any event plans. When preparing our financial statements, while preparing our financial statements also we use estimates. For what purpose? In accounting,
Forecasting the future profitability.
forecasting the future. There's another simple example also. Forecasting the financials. Can you remember in LKS 16, there is a concept called depreciation, no? So, in order to depreciate an asset, we need the useful life of an asset, right? So that useful life of an asset also a kind of estimate. We just estimate for this from today to this period we can use this asset. That is an estimate. So at the time of determining or deciding the useful life of an asset also we use our estimate, right? So we can't ensure the accuracy of these estimates. We just assume we can use up to 5 years or 10 years, but those are uncertain, right? So those are the inherent limitation in accounting which prevent us from providing a reasonable assurance. Is that clear? Also, we need to make judgments, right? When we are accounting for elements of bad debt or doubtful debt, then we use our judgments, right? We may provision for as bad debt allowance. Let's assume 200 million. We assume we won't be able to recover from the debtors rupees 200 million. But we can't ensure that exactly we won't be able to recover this 200 million because some of the debtors will pay from their debt amount, right? Such kind of things will prevent us from providing the absolute assurance, right? Next one is future events may differ from historical data. It is obvious now. Normally, we do audit based on the historical data, right? So we can just provide an assurance regarding the historical data, but we can't predict the future. Next one is some transactions involve complexities that are difficult to access, right? Because some transactions like hedging and all, those are complex transactions, complex accounting treatments also involved in that. So at that time, it will be difficult to assess the accuracy of the data and transaction. Also, management discretion in applying accounting policies. So most of the time, when we are preparing the financial statement, we must develop the accounting policies, right? We must consistently apply those accounting policies for the future periods also. So if management made any wrong accounting policy, let's say, then it will affect the reliability of the financial statement. So these kind of inherent limitation of accountings also will prevent us from providing an absolute assurance. That is the third one. The final one is resource and time constraint. Right? Audit must be completed within reasonable time frames and budgets. We need to complete our audit within 1 or 2 months, which took to prepare those financial statements 1 year, right? So we need to examine all the transaction, and also we need to test the samples and need to do all the audit procedures for this thing, right? So accountant, he has prepared this financial statement in 1 year, but as an auditor we need to examine this 1 year transaction in 1 or 2 months. So there is a time constraint. So it will allow only to test the samples, right? That's why we test the samples instead of testing the entire population because of time constraint, right? So not all areas can be examined in the exhaustive detail. Because of this time constraint, we won't be able to test the all areas. right? We only just test the material transactions, right? Therefore, we only relying on sampling and analytical procedures as well as inquiries, right? So these are the four inherent limitations that prevent us from providing absolute assurance. Is that clear? If you have any doubts regarding these limitations, please let me know. Is that clear? Okay. What about others? Lakshani, Hansa, and Manas?
Yes, clear.
Okay. Okay. Okay then. So these are the four inherent limitations which preventing us from providing the reasonable assurance as an auditor, right? That's why we provide the reasonable assurance rather than absolute assurance. Always keep in mind there is no any assurance called absolute assurance because it represents the 100% certainty. We can't, in any circumstances, we can't provide this 100% assurance. Please keep in mind, therefore, there are only two levels or two types of assurance. One is reasonable assurance, the other one is limited assurance. Okay, keep in mind. Right. Next one is management's responsibility. Right. What are the management's primary responsibilities? Number one, preparation and presentation of financial statement. The primary responsibility of preparing the financial statement as well as presenting the financial statement is with management. It's the management's responsibility. Therefore, they must ensure that they have prepared the financial statement with in accordance with applicable framework. If it is in Sri Lanka, it's obvious they must comply with SLFRS as well as LKS, right? Also, they must comply with the Companies Act, IRD Act. Also, next one, management must ensure statements present true and fair view. As an auditor, we just provide an opinion regarding this true and fair view, but it is a responsibility of management to ensure that their financial statement present a true and fair view in all material aspects without any material misstatements, right? That is their responsibility. Next one, apply appropriate accounting policies consistently. Let's assume management has decided the straight line basis for their depreciation purpose, right? Straight line basis depreciation method in the year 2024-5, right? This is their policy. So they have disclosed these things in their financial statement also. But when we are preparing the financial statement in 2025-26, they change their accounting policy for the depreciation as reducing balance method, right? Again, when they are preparing the financial statement in 26-27, they use straight line basis. Here, the consistency is not there. Therefore, it is also management's responsibility to apply appropriate accounting policies consistently, right? If they are changing, then also they should provide the reasonable or valid reasons for their change in the accounting policies. Clear? Therefore, it is an it is a responsibility of the manager to apply those accounting policies consistently, right? So if you go through the LKS 8, as I remember, right? Estimate errors and changes in accounting policies standard. They have clearly mentioned the accounting policies must be applied consistently. If you need to change that accounting policy, there are two requirements. Please go through that thing. Okay. Next one is make necessary disclosures, right? So it is also a manager's responsibility to disclose all the important information in the financial statement, right? So this is the first responsibility of the management. The second one, internal control over financial reporting, right? So design, implement, and maintain the effective internal controls also the responsibility of the management. Those things are not the responsibility of the external auditor. Those are the responsibility of manager. And establish the control environment and tone at the top, which means in an organization, first of all, the managers or the leaders must create the control environment, create the tone, which means, let's say, if manager is acting ethically, then the other employees follow the follow that ethical principle. That is the tone at the top. So it is also management responsibility to establish the control environment, right? Next one, ensure controls are operating effectively. Only implementing the internal control is not sufficient, right? They must ensure they are operating effectively. Otherwise, what will happen? Control might be there, but no one will follow that controls. No one will adopt those controls. Then no use of such kind of controls. Therefore, management must ensure controls are operating effectively, right? Next one, monitor control performance and address deficiencies. Continuously, they must monitor the control performance, whether those controls are operating effectively or not. Do we need to do we need to make some changes or not? Right? Such kind of things also should be done by this management. Those are the responsibilities. So first one is preparation and presentation of financial statement. The second one is internal control. right? Third one is to provide the auditor all the informations without any restrictions, right? This is the third responsibilities, right? So to provide the auditor with access to all important information used to prepare the financial statement, right? Let's say if your auditor is asking for the document that you used to prepare the financial statement. If you say no, I can't provide that document, that those documents are very confidential, so I can't give it to you. If you say like that, then you are not fulfilling your responsibility, right? It is your responsibility if an auditor asks you any document, then you must provide such documents, right? You can't say those are confidential, therefore I can't give it to you. You can't say like that, right? Also, you must provide additional information that the auditor may request from management. If auditor requests you any other additional informations, then as a management, you must provide, right? Also, unrestricted access to person with the entity, simply employees, right? From whom the auditor determines it necessary to obtain audit evidence. If auditor determine to obtain some information through inquiries from employees, then as a manager, you must provide the unrestricted access, which means you can talk to any employees as you want. That is then unrestricted access. So these are the management responsibilities. So please let me know how many management responsibilities are there. We told, right? What are the management responsibilities? No one is ready to talk. Okay. One is preparation and presentation of financial statement. Second one is internal control. Third one is provide information to the auditor, right? So auditor's role is not prepare financial statement or implement control. Their role is to audit management's representation and the effectiveness of their controls and process. This is the auditor's role, right? So we are not responsible for preparation of financial statement or any implementation or designing of internal control. We only, our role is as an auditor to audit the management representations, which means assertions. Assertions. We will discuss this thing later in detail. So we must audit the management representation as well as we must audit the effectiveness of their controls through test of controls. Right? This is one of the procedure we use in the audit. Test of control in order to test the control, effectiveness of the control. Right? Okay. Our next topic is auditor's responsibilities, right? The primary responsibility of the auditor is to planning the audit. Second one is assessing the risk, obtaining audit evidence, applying professional skepticism and professional judgment, then evaluating the misstatement, and finally forming opinions and reporting. These are the auditor's responsibility. Let's see one by one. Planning the audit. Before conducting any audit or before accepting any audit, first of all, we need to gain the understanding about the entity as well as its environment. Who are the competitor? What is their business process? What is their business nature? Right? Those things also we should get the understanding. Next one is identify risk of material misstatement. Right? Which means we need to identify what are the areas that involved with the high risk. Also, based on the understanding and the risk assessment, we need to develop our audit strategy. How we are going to conduct this audit, right? What are the procedures that we are going to use in order to complete this audit? Such kind of things we need to plan. That is our responsibility as an auditor. Okay. Once we develop the audit strategy, then we should determine the nature, timing, and extent of the procedure. To what extent we are going to test, to what extent we are going to conduct this audit, right? Who are the parties, who are the professionals, or who are the seniors that are going to involved in this audit? Such kind of things we must determine at the time of planning the audit. Those are the primary responsibilities of the auditor. Hope you got those things. Second one, assessing the risk. Right? When we are assessing the risk, we must assess those risks in two levels. One is at financial statement level, the second one is at assertion level. Right? So initially, we must identify and assess risk at financial statement level. For overall financial statement, what are the risks that are available? And also we should evaluate the significance of the risk, right? Whether it is high, moderate, or low. If it is high, then we must pay more attention for those areas, those risky areas, right? Next one is assess the risk at assertion level, right? Which means normally financial statements are prepared based on the management representations, right? That those management representation we called as an assertion. So we will discuss this thing later. For the time being, just keep in mind at the time of assessing risk, we must assess the risk at the assertion level also, right? Next one is evaluate control design and operating effectiveness. Here we do the control test, right? Before we do the substantive audit procedures, detailed audit procedure, initially we test the controls, effectiveness of the controls, right? If the controls are weak, then we plan or then we change our audit procedure in accordance with that. If it is weak, then we do more audit procedures. If the controls are high, then those are effective, then we do some simple procedures, right? Therefore, it is the responsibility of an auditor to evaluate the control design and operating the effectiveness, as well as determine the materiality level, right? Determining the materiality level also responsibility of the auditors, but in order to determine the materiality level, auditors must use professional judgment. Their professional judgment, right? Professional judgment should be used in determining the materiality level, right? So these are the responsibilities. Next one is obtaining audit evidence, right? Once you perform these two things, plan the audit and assessing risk, then you must design and perform audit procedures. Perform audit procedures. When you're performing audit procedures, you must obtain sufficient and appropriate audit evidence. Not just audit evidence. These two terms must be there. Two things must be there. One is those evidence must be sufficient in order to get a conclusion, as well as those evidence must appropriate, right? Next one is use mix of substantive and control procedures. When we are test when we are performing audit procedures, we can do TOC, test of control. Next one is substantive procedures. Under the substantive procedures, there are two things. One is analytical substantive procedures, right? The other one is test of detail. Those are the audit procedures we normally use in an audit. Finally, document all evidences and findings. Right? We must document all the evidence that we obtained and also the finding that we have. Right? So, this one is also the responsibility of the auditor. Next one is applying professional skepticism and judgment. Right? When we are auditing, we must always use our questioning mind, right? Make sure to use this professional skepticism in your professional life only, because otherwise it will lead to some problems, right? So when you're auditing, you must maintain the questioning mind throughout the audit, right? You must challenge management representations. Please make sure don't rely with the management's explanation. Make sure to gather evidence as well as challenge their assertions and decisions. Also, you must evaluate evidence objectively without any bias, right? Hope you remember we discussed the ethical principles in the last class. So, objectivity is one of the principles. Hope you remember, right? Can anyone tell how many ethical principles are there. So what does extent of procedures and operating effectiveness means and what is called substantive procedures? For the time being, please keep those things in your mind because there is a separate chapter for these audit procedures. At that time, we will study those things. What are the audit procedures that we should perform in audit? Under that, there are two types. One is test of control, the other one is substantive procedure, right? When it's come to the test of control, in the sense, we just only testing the controls, effectiveness, and whether those controls are effective. Sometimes controls may be there, but it won't be effective that much, right? Those things we will learn in next 2 or 3 chapters. So for the time being, just keep in mind these things. Is that okay? Okay. Right. So please tell me how many ethical principles are there? Anyone? Hope you remember those things. 5. Very good. 5. Right. Those are integrity, objectivity, confidentiality, professional competence and behavior, professional competence and due care, as well as the professional behavior. Those are the ethical principles. Keep in mind, right? So objectivity also such kind of ethical principle. So when we are evaluating an evidence, we must evaluate those evidence objectively without any bias, right? We should not make decision based on our preference, based on our opinion, right? We must always rely with the sufficient and appropriate evidence. When it's come to the evidence, please keep in mind it must be sufficient as well as appropriate. Sufficient in the sense those evidence should provide reasonable ground to make the decision, right? As well as appropriate in the sense it must be suitable for the content, for the transaction. For a time being, just keep in mind. As well as exercise professional judgment appropriately. Professional judgment in the sense, as an accountant or auditor, this is, we are talking about auditor's responsibility now. As an auditor, we must use our knowledge, skills, experience when we are doing audit, right? So applying professional skepticism and professional judgment also one of the auditor's responsibility. Next one is evaluating misstatements, right? Once we complete the audit, we must accumulate identified misstatements in order to assess whether those misstatements, whether those aggregated misstatements exceeds our materiality level or not. In order to find that, we must accumulate our identified misstatement. Let's assume you are a senior in the engagement team, right? You determine the materiality level, materiality The materiality for the financial statement is, let's assume 10 million. This is the material level, right? Which means if any omission or misstatement that exceed this 10 million, we consider those omission or misstatement as material, right? So at the time of auditing, you have identified misstatements like this. There is a misstatement in revenue, which is around, let's say, 2 million. So this is immaterial. So no need to modify our opinion. We just need to communicate those things, right? So revenue, there is a misstatement of 2 million, right? When it's come to the expenses, there is a, let's assume there is there is another misstatement of 5 million in expense. And in asset side, under PPE, there is a valuation misstatement around, let's say, another 3 million. And also under liability, there is a misstatement, which means, let's say, our liability is understated by 2 million. Okay, these are the misstatements that we identified in our audit procedures, right? Now you can say, by looking at these misstatements individually, those are immaterial, right? Immaterials in the sense, those are below 10 million, right? This is 2 million, 5 million, 3 million, 2 million. Those are individually, those are immaterial, right? But as an auditor, it is your responsibility to accumulate identified misstatements in order to assess whether those misstatements exceeding our material level or not, right? Right. We have completed our audit procedures. Now let's accumulate those misstatements. Okay, 2, 5, 7, 7, 3, 10, 12. But what happened here? Right? What happened? When we aggregate those individual misstatements, though that aggregate misstatement exceed our material level. If it is exceeding our material level, it is obvious we must modify our opinion, or else we must communicate in order to rectify these misstatements. Is that clear? If you have any doubts, please, regarding that accumulation of misstatement, please let me know. Is that clear? Is that example clear? Determining the material level and all, we will discuss in separate chapter. Don't worry about that thing. But please let me know the way of accumulating the misstatement is okay or not. Is that clear? Or do I need to explain once more? If so, please let me know. I can explain once again. Manas, Zahra, Ansa, Lakshani, is that clear? Okay. You need once again, right? Simply, once you complete your audit procedure, It is your responsibility to accumulate the identified misstatement, which means evaluating misstatement, right? So misstatement in the sense it can be any error, any recording omissions, right? If you can omit your invoice, one of your invoice without recording in your financial statement, such kind of things we consider as misstatements, right? Arithmetical error could be there, right? But at the end of the audit, we must accumulate those identified misstatements, right? Let's say we have identified these kind of misstatements in our audit. First one is when we are testing our revenue, we found that one of invoices invoice omitted from recording, right? They have omitted. They forgot to record that 2 million in the financial statement. So one of the misstatement. Second one is expense. They have overstated their expense by 5 million, right? Let's say in order to reduce the tax burden, they have fraudulently overstated their 5 million expenses, right? That is one of the misstatement. But our material level is 10 million now. At the time of planning our audit, we must determine the materiality. It can be based on the revenue, profit before tax, assets. There are some criteria in order to determine the materiality. The please for the time being, just keep in mind there is a concept called materiality, but the broad explanation will be given on the separate chapter, right? So let's assume we have determined our materiality is 10 million, right? In when we are looking these misstatement individually, those are immaterial, no? In previous classes, I have already given the definition for the materiality, right? Hope you all remember that. Materiality in the sense if any omission or misstatement that could affect the economic decision of the stakeholder, we consider those misstatement or omission as material, right? So revenue 2 million, there is a material mistake. Sorry, there is a misstatement. Expense they have overstated by 5 million. So this misstatement is below than our material. Next one is let's assume our one of our asset, right? They have mistakenly recorded 3 million expenses as an asset. Let's assume. Then that is also one of a misstatement, right? 3 million. But if we compare with our material level, it is below material, right? 3 million, no? But our materiality level is 10 million. Next one, liability. Let's say we have loan balance, but we have understated our loan balance by 2 million. In the bank confirmation, they have, let's say, in bank confirmation, the actual loan balance is 100 million. We payable. This is from the confirmation balance. But in financial statement, they have recorded 98 million, which means they have understated by 2 million. So that is one of the misstatement, right? But at the end, we must accumulate those individual misstatement in order to evaluate whether those aggregated misstatement exceeding this materiality level or not. Hope you get the idea, right? So if we At these individual misstatements, we get the sum of 12 million. 12 million is above our material level. Clear? Aggregately, it is exceeding our material level. Therefore, we need to consider in order to modifying our opinion, or else we must communicate these misstatements, right, in order to reduce to the acceptable level. If we can reduce this misstatement below this 10 million, then we can provide the clear opinion, right? Hope you got this. Is that clear, Lakshani? Not only Lakshani, others also, please let me know. Is that thing clear? Okay, right. Also, it is our responsibility as an auditor to evaluate the qualitative factors, not only the quantitative factor, right? We must always evaluate the qualitative factors also, the risks and the control weaknesses. Those are the qualitative, no, we can't measure in quantitative terms. Such kind of things also we must evaluate, right? Control weaknesses as well as risk factors, as well as going concern related issues, going concern. Those things cannot measured in terms of numbers, no. Those are the qualitative factors. We must evaluate whether the appropriate disclosures, sufficient disclosures are included in the financial statement or not. Such kind of things also we must evaluate. If the disclosure is insufficient, we must request the management or the client to provide the sufficient disclosure, right? Finally, determine appropriate adjustments or disclosures, right? Let's say there is a going concern issue, but management has failed to disclose such thing. We can communicate with them. If they provide clear disclosure, then it is okay. If they fail to provide, we must make the disclosure, as well as we must add a paragraph in our audit report. We discuss this thing in our last lecture, right? Under emphasis of paragraph, we must disclose this thing. Management has failed to disclose the going concern issue. Likewise, we should disclose such thing. Those are the responsibility of an auditor. Finally, forming opinion and reporting. So once we evaluating material misstatements and misstatements, qualitative factors, risk factors, all the things, finally, we must determine whether to issue unqualified, qualified, or adverse opinion, right? Now you all are familiar with these terms, right? Unqualified opinion, qualified opinion, adverse opinion. Hope you all familiar with these terms and hope you know the way how to form this kind of opinion and all, right? I hope so. Next one is prepare audit report in accordance with standards, right? Mostly audit opinions are regulated by SLA US 700. Sri Lanka Auditing Standard 700 in Sri Lanka. In global level, ISA 700. From 700 onwards, SLA US 700, 701, etc. Those relevant for the audit report and opinion, right? So when we are preparing our audit report, we must comply with these standards, meet their requirements, criteria, and all, right? We can't provide any audit opinion or audit report as our wish. There is a separate format. There are some contents. We discuss those things also, right? Hope you all okay with that, right? So we must comply with those criteria and rules. Next one is communicate with audit committee or board, right? If it is a PLC, they will have this audit committee. So all the audit findings and weaknesses, we can communicate with them. Or else, if they don't have any audit committee, we can communicate with board of directors, right? Management regarding our audit findings, as well as our findings about the control weaknesses and all. Next one, provide management letter on internal control matters. Let's say during the audit, we found there are so many internal control weaknesses. So we must communicate those internal control weaknesses through management letter, right? Keep in mind, management letter. In management letter, please make sure to write these things in any paper if you wish, right? In management letter, normally we include the findings. If we found it's obvious, if any material misstatement are there, we must include those things. What are the findings? Let's go for that example that we discussed earlier. Revenue has understated by 2 million. No? Then we must write under findings topic, the management has failed to record 2 million worth of invoice dated blah blah blah, right? So that thing we must include under finding. And next, we must include recommendations. Recommendation, right? Let's assume if it is relevant for any control related thing, then we can recommend an effective control procedure, right? Under the recommendation. Finally, through these many, one of the, sorry, the board or the audit committee must sign this management letter and provide the copy for the auditor also. This is about the management letter, right? So these 6 things, starting from planning an audit to forming opinions, these are the responsibility of the auditors, right? What are they? It starts from planning the audit, assessing the risk, evaluating, sorry, obtaining audit evidence, applying professional skepticism and judgment, evaluating misstatements, and forming opinions. These are the responsibility of an auditor, right? Is that clear? So now you can differentiate the management responsibility as well as the auditor's responsibility. right? Is that clear? Now you know the distinction between management responsibility as well as the auditor's responsibility, right? Hope it is clear. Right. Okay. Earlier we discussed it is auditor's responsibility to apply professional skepticism and professional judgment. No. Okay. Let's see what is professional skepticism and what is professional judgment. How these matters, right? Okay. In IAS 200, ISA 200, they have provided the definition for this professional skepticism. It is an attitude that includes questioning mind, being alert to conditions which may indicate possible misstatement due to error or fraud, and critical assessment of audit evidence. Simply, it is an attitude we are using our questioning mind and we are being alert to those conditions which arise the indications about the error and fraud, right? That is professional skepticism. So key components of professional skepticism. Key components of professional skepticism. One is questioning mind, right? Always we should ask why and how about management representations, which means normally management prepare the financial statement based on their assertions, management assertions. So we should ask why, how this happened. Do you have any supporting documents regarding this? Likewise, we need to ask questions from them, right? Challenge assumptions and premises. We must challenge management regarding their assumption, estimates, and policy and all. If we know that is wrong, then we must challenge them, right? Seek evidence before accepting representations, right? We must always ensure there are sufficient and appropriate evidences for those representation or assertion, right? Okay. Next one, maintain healthy skepticism even about trusted relationship. We may familiar with those clients, but we must always apply our professional skepticism, right? We should not rely with their explanation. Okay, excuse me. So this is one of the component of professional skepticism. Second one is critical evaluation, which means we must analyze evidences objectively. Also, assess completeness and reliability of the evidence, right? If we have evidence, we must assess these things. Those evidence are complete and also reliable, right? Okay. as well as consider alternative explanations. If we are not clear with some explanations which is provided by management, we must consider alternative explanations, right? Also, we must look for contradictory evidence. Let's say there is a bank balance, right, in your financial position. You can test using bank statement as well as you can obtain the bank confirmation in order to verify the balance, right? So likewise, you must use contradictory evidences, right? Next one is awareness of fraud risk. You must being alert to signs of frauds. If any red flags are there, you must be alert, right? Next one is resistance to management pressure. If management is pressuring us from doing our audit, if they are interrupting our procedures, we must resist, right? Also, we must maintain independence as well as we must document those pressures that has given by the management, right? Those are the key components. What are they? Questioning mind. Second one is awareness of fraud risk. Sorry, critical evaluation, awareness of fraud risk, and resistance to management pressure. These are the component of component of professional skepticism. Why professional skepticism matters? Why it is important? Because it prevents auditors from becoming too comfortable with known entities. All right. If as an auditor, if we become too comfortable with the entities, then we won't evaluate the appropriateness, sufficiency of the evidences and all. Right? It will impair our independence also. Therefore, it is important to maintain the professional skepticism, right? It reduces audit risk by ensuring critical evaluation, right? When it's come to the audit risk, there are three types of risk. One is inherent risk, second one is control risk, third one is detection risk. These inherent risk and control risks is the responsibility of management, but the detection risk is the responsibility of auditor, right? Which means if we fail to detect the risks, it will lead to provide an inappropriate opinion. So that is the detection risk. So if we apply this professional skepticism, right? If we apply this professional skepticism, then we can reduce our audit risk, right? In next chapter, we will discuss this audit risk separately and these three types of risk also. So for time being, keep in mind, detection risk is the responsibility of the auditor. In order to reduce that audit risk or the detection risk, auditors must maintain or apply this professional skepticism. That is one of the importance of the professional skepticism also. helps to identify unexpected errors or fraud, right? Also, protect against management manipulations of financial statement, right? Okay. There are three examples how we can apply our professional skepticism. Example one, a Sri Lankan export company recognizes revenue on goods ready for shipment. They, they are, what is the standard that is applicable for revenue recognition? Can anyone tell? Very good. It is SLFRS 15, right? So when we are recognizing a revenue, there are five criteria that must be satisfied, right? If your performance obligation is to one of your performance obligation is to deliver the goods, before you completing your delivery, you can't recognize your revenue, right? Because you must complete your performance obligations, right? So here, an export company recognized revenue on goods ready for shipment, but they didn't deliver, right? Here, but shipment never occurs. If you didn't apply professional skepticism, you might accept management representation. It is okay, no problem. But if you apply professional skepticism, for sure, as an auditor, you will verify actual shipment. No, no, no. We can say like this, no. If management is saying we have recorded all the revenue in our financial statement, as an auditor, if we are applying the professional skepticism, we can say no, no. We can't rely on your verbal confirmation. Please provide us evidences, right? If they fail to provide the evidences, we can obtain confirmation from customers also in order to verify the delivery of these goods, right? This is how we use our professional skepticism. Next one is asset valuation manipulation, right? Second example, a real estate company values properties at inflated amounts, right? Which means they are showing those values by overstated amounts, inflated amounts, right? So management provide valuation report from related parties. As an auditor, if we use the professional skepticism, we must evaluate the independence of the valuator, right? If the valuation report is from a related party, then the independence is not there. If the independence is not there, then we can't accept that as a valid valuation report. Okay. So we must use our professional skepticism. If they are providing an valuation report, we must question who evaluated this, right? Then we must evaluate the independence of the evaluator. Is that an employee of the company or a related party of this client or else any key management person of this client or not? We must evaluate such things by using our questioning mind. Then we must evaluate the competency of the evaluator also, right? Those are the things that we must evaluate by using our questioning mind, right? Always remember, we should not rely with management's representation. We must ensure we must get the evidences using our questioning mind, right? Next one is expense allocation. Management allocates overhead across cost centers using formula that benefit reported results, right? Auditor should skeptically question allocation methodology, by using which basis you allocate this overhead cost. What is the basis for this allocation? Such kind of things you get to know by questioning from management, right? This is the way how we apply our professional skepticism, right? Next one is professional judgment. Definition is the application of appropriate training, knowledge, and experience within the context established by auditing standard to make informed decision about the courses of action that are appropriate in the given circumstances, right? Which means professional judgment is simply application of our knowledge, skills, as well as the experience, right? For an example, let's say one of our client has using uh, for computer and accessories class of assets, they are depreciating over 10 years. Let's say see 10 years. Computer and accessories, they have the policy for depreciating these computer and accessories for 10 years on, let's say, a straight line basis. That is okay, right? But as an auditor, if we apply this professional judgment, how we can apply? Because we have experience, right? We have audited some other similar clients also. So we can compare their policy with their industry. Then we can get the knowledge how in with the industry of this client, how they apply this depreciation policy. Based on that, we can make the judgment if it is appropriate or not, right? So areas requiring professional judgment, one is materiality determinants. So in order to determine material levels, we must use our professional judgment, right? So overall, there are three types. When we are determining materiality, we need to determine three things. One is overall materiality level for the financial statements as a whole. Next, we must determine the performance materiality and also assess the trial threshold. This is like this. Let's say your base for materiality calculation is revenue. Let's assume we are going to calculate the materiality based on revenue. Your revenue balance is 120 million. Okay. From this, you decide to determine this materiality level. Normally, overall material for those overall materiality and all, CA Sri Lanka has given some thresholds, right? You must use that. So if you are calculating the materiality based on revenue, then you can determine within the range of 1 to 2 percentage, right? Which means from 120 million, you can decide 1% is your overall materiality level, right? For the performance materiality in the sense, a materiality level below the overall materiality, which means 75% of this materiality level. Those things we will discuss later, right? For the time being, just keep in mind materiality. There is a separate chapter. Way of calculating materiality, thresholds, and so all we will discuss, right? Next one is trivial threshold is around normally we use to calculate 5%. Right? So when we are determining the materiality level, we must use our professional judgment. Next one is risk assessment. When we are assessing the risk also, we must use our professional judgment. Next, audit evidence evaluation. In determining sufficiency and appropriateness of audit evidence, we must use our professional judgment, right? And also when evaluating the reasonableness of the estimates, which means in accounting estimates, we must use our professional judgment. Next one is financial statement presentation. In order to evaluate the appropriateness of accounting policies, as I mentioned you earlier, we must use our professional judgment, right? Next one is audit conclusion. In providing or forming audit opinion also, we should use the professional judgment, right? Okay. Next one is quality control of judgment. We must establish quality control policies to ensure the consistent application of judgment, right? For the same types of company, we must apply our professional judgment consistently. If those companies are operating in the same industry, then we must use same judgment for both companies, right? Hope you got that point. Next one is review significant judgments made. If we made any significant professional judgment, we must get the independent review of another person from another person, right? Also, we must document all the rationale for those decisions or the judgments, right? These are the quality control framework, right? I told you earlier we will discuss about the management representation, no? Which means assertion, right? Okay, this is the thing. So what are management assertions or representations? It means representation by management, explicit or otherwise, that are embodied in the financial statement, which means at the time of making the financial statement, preparing the financial statement, managers use some representation in order to in order to provide that their balances are accurate, complete, those are free from material misstatement, right? For such things, they use some kind of representations, assertion. Look at this example. Let's say if they are in the financial position, there is a trade receivable balance 200 million, right? In financial position, there is a trade receivable balance 200 million. The representation they use is like this. This account balance exists as of the balance sheet date, which means actually there are debtors they owe to pay us. Existence. Actually there are receivable balances, right? As well as all transactions have been recorded in the correct period. right? Let's say there is a vehicle in financial position. They have recorded around 120 million, right? For that vehicle. So by recording this amount, they are trying to tell us this vehicle is valued at appropriate amount. They are not writing under this amount. These amounts are appropriately valued by the valuator. They don't do such thing. But if they provide any figures in the financial statement, they are using some representations. They are providing some representations, right? Okay. Why these assertions matter? Why it is important? Because auditors design audit procedures based on these assertions, right? That is the one thing. Next one is assertions provide framework for linking risk to a specific account balance. Also, failure to address these assertions. Keep this thing in your mind clearly. If we fail to address assertions, will leave audit gates, right? It can be clearly identified by understanding these three categories of assertions, right? Normally, management use these three categories of assertions. One is assertions about the class of transactions and event, which means assertion used to prepare the P&L, statement of profit or loss. Second one is assertions about account balances at the period end, which is assertions that used to prepare the balance sheet or financial position. Balance sheet. Third one, assertion about presentation and disclosure. This is about the disclosure notes. Disclosure notes. Right? Disclosures. So these are the three types of or three categories of representation or the assertions that is used by the management. One is assertions about class of transactions, which is assertions of statement of profit or loss. Second one is assertions about account balances at the period, which is assertions of balance sheet or statement of financial position. Next one is assertion about presentation and disclosure, right? Okay, let's see one by one. First one is assertions about class of transactions and events, right? Which means for what purpose we use these assertions? Can anyone tell? Assertions about class of transactions and events. For what purpose we use these assertions? In order to prepare the anyone? We use in order to prepare the statement of profit or loss, right? Statement of profit or loss. No one is answering, right? So under this, there are five assertions. There are five assertions. One is occurrence. Occurrence in the sense transactions and events that have been recorded actually occurred, right? Let's say you have recorded the revenue in your P&L, right? Which means you are saying you have those revenues, those figures comes from the actual transactions, actually occurred transactions, right? That is occurrence. So as an auditor, we must focus, did the transaction actually happen? We need to obtain evidences in order to verify that occurrence. Is that clear? If you have doubt, please let me know. Occurrence means all the transactions events that we have recorded must actually occur, right? It must actually occur. Let's say management has recorded one of the invoice in 24-25, but actually the invoice is dated on 1st January 2026. We are recording a revenue which is not occurred in that period, right? That is occurrence. Second one is completeness. All the transactions and events should have been recorded, have been recorded. Which means, let's say, like this, there are, let's take revenue as an example, right? Revenue. Okay. During the year, let's assume you have you have sold, you have sold, right? 100 machines. Let's say you are a machines manufacturing company. So during the year, you have sold 100 machines, which means you have 100 invoices for those 100 sales. So when you are preparing the statement of profit, P&L, profit or loss, you must record these 100 invoices which actually occurred during the period. That is occurrence. Second one is completeness, no, which means all transactions and events that should have been recorded have been recorded, which means during the year you have made 100 transactions, which means you have 100 invoices. You must record all those 100 invoices in your financial statement, right? Let's say you recorded only 90 invoices and you omitted 10 invoices without recording. So is that represent the completeness? No, right? Completeness in the sense if 100 transactions take place, then you must record all the 100 transactions in your financial statement. That is completeness. So occurrence is here. We have made 100 machines and sold for 100 customers, that is occurrence. We have 100 transactions. Completeness in the sense we have recorded all the 100 transactions in our financial statements. That is completeness, right? Third one, accuracy. Okay, we have recorded all the 100 invoices, right? But the third thing is accuracy. Is the sum of these 100 invoices correct or wrong? That is the third thing, accuracy. Let's say you have recorded the 97th invoice as 10 million rupees, but the actual amount of the 97th invoice is 11 million. So there is a 1 million difference, no? Which means accuracy is not there. If you have recorded 100 invoices, also you must ensure the sum of those 100 invoices are accurate, right? Accuracy in the sense amounts and other data relating to recorded transactions and events have been recorded appropriately. As an auditor, we must check whether those recorded transactions or those recorded amounts represent the correct balance or not. We must ensure that in order to verify the accuracy, right? Next one, cutoff, which means transactions and event have been recorded in the correct accounting period, right? If you are preparing the financial statement from 1st of April 2025 to 2026, which is 31st March 2026, then let's take the same example. You must record those transactions took place between these period only, right? Let's assume you have recorded one of the invoices which is dated 1st April 2026. Please let me know, is this invoice relevant for this period, for this our accounting period? Is that relevant? Manas, Zahra, is that relevant? Our accounting period is 1st April 2025 to 31st March 2026. But we have included an invoice which is dated 1st April 2026. No, very good. No, it is not relevant for our period. Therefore, it is a cutoff issue. That is cutoff, which means we must record transactions events that have been recorded in the correct accounting period. So as an auditor, we must focus our transaction recorded in the right period or not. We must ensure that, right? Next one is classification, which means transactions and events have been recorded in the proper accounts. Let's say you have purchased an asset, right? You have purchased an asset, but during the period, you have expensed that amount in under administrative expenses. Is that correct? If you have expensed a purchase of an asset in your financial statement? No, because if the criteria are met, if it is falls under LK 16, it should be treated as capital expense, right? Therefore, you cannot include such kind of expense under PNN. Those are classification errors, right? Therefore, as an auditor, we must ensure the transactions are in right account. The classification is appropriate, right? These are the assertions or representation we used in statement of profit or loss. Is that clear? Is these all are these all assertions clear? If you have any doubt, please let me know. I can explain. So that is clear, right? So how many assertions are there? Assertions are there for class of transactions in events. There are five. We start from occurrence, completeness, accuracy, cutoff, and classification, right? Okay, let's move to the next one. Assertions about the account balance at the period end, which is we used to prepare the balance sheet or the statement of financial position. It starts from the existence, which means assets, liabilities, and equity interests that are included in the financial statement exist, right? Let's say you have recorded the motor vehicle, amount is 120 million. If you have recorded under PPE this amount, that asset that asset must exist, physically exist, actually exist, right? It cannot be a fictitious one. It must be a real vehicle. Clear? That is existence. Second one is rights and obligation. If you have recorded this motor vehicle under asset, it must be in your company name. It must be registered under your company name. If it is not registered under your company name, then it is not your asset, right? Rights and obligation is that the entity has the right to asset and liabilities are obligations of the entity. Let's say you have recorded a liability of your own bank loan, not in your company name. Then it is not a liability. It is not an obligation of the entity. It is the obligation yourself, right? Such kind of thing we should consider in financial position, right? Third one, completeness. All the assets, liabilities, and equity interests that should be included have been included, which means, let's say you have 10 vehicles in real. Harinder, let's assume you have 10 vehicles. But in the financial position on the property, plant, and equipment, you have recorded only 8 vehicles. So it is incomplete. It is not representing the completeness, right? If it want to be a complete disclosure, you must include all the 10 vehicles, right? So as an auditor, you must focus, are there any omitted assets or liabilities, right? Okay. Fourth one, valuation and allocations. Let's say, let's take the same previous example. That motor vehicle you recorded as 120 million, right? Now, you must ensure this 120 million is recorded at appropriate amount. This is the appropriate valuation. You must ensure that. That is valuation and allocation, right? Let's say the actual valuation of this motor vehicle is 150 million. but you have recorded as 120 million, then there is a valuation error. There is a valuation error. Those things should not be there in your financial position, right? So as an auditor, you have the responsibility to ensure that this balance or this valuation is appropriate or not, right? Next one is assertions about the presentation and disclosure, which means occurrence and rights and obligations, which means you must disclose all the occurred inf- informations and also the other things. When it's come to the completeness, you must disclose all the things, right? All the required disclosures. Classification and understandability. If you have classified some transactions, then you must disclose how you classify those things. And next one is accuracy and valuation. If you are disclosing any quantitative informations, then you must ensure those disclosed quantitative information represent the accurate amount as well as the valuation of those disclosed things also accurate. You must ensure those things. So these are the assertions that you use in financial statements. Is that clear? Keep in mind for P&L, for profit or loss account, profit or loss statement, there are 5 assertions. For balance sheet, there are 4 assertions. For the presentation and disclosures, there are 4 assertions. Right? No need to worry about these things under disclosure. Is other things clear? Please let me know. Is Do you have any doubts regarding the assertions? Is that clear? If you have any doubts, please put it in the chat box. Is everything okay? Clear? Okay. What about Monas?
Clear.
Okay. Buddhiga, is that clear? Hope you joined just now or earlier. I didn't see your name for a while. Just now. We are going to end the class. It's okay. Please refer the recordings if available. So this will be most important one for your examinations, right? Because you will be asked some questions based on these assertions by giving any case study. So make sure you are okay with these assertions, right? Okay. So let's try one of the question. I'll ask one question. Please make sure to answer this one. Okay. You will be given this kind of question. Okay. Case study in the sense they will give you a scenario and ask you a question. Is this visible for you all? That document I am sharing right now, the Word document. Okay, Buddhik, it's okay. Yeah, this is visible, no? Right. Okay. Okay. Just read this from, sorry, it is not editable. Right? It's okay. Just read the first paragraph and then read the situation 4. Right? Just read this first two line and read the situation 4. And please let me know what is the assertion that they have violated, right? By reading this. Please put your answers in the chat box. Just read the first two lines and situation 4. And please let me know the assertions they have violated in this financial statement. No need to read all the things. Just first two lines and the situation 4. That's it. I need the answers from all, right? I got one answer. What is the assertion that has been violated by the management in situation 4? That is the question. Only one answer so far. Okay, let's see. Assertions about account balances at the period then. What is that specific assertions? Under account balances, there are four assertions, no? There are four assertions. What is that specific assertions? I'm asking, Zahra. What is the specific assertions that they have violated under account balances? That is the question. The specific assertions violated here is cutoff, right? As well as the valuation, right? Valuation, because they have counted this amount after the year end, right? And they have included in the current period. So the valuation is in question, right? I will upload this question paper. Please make sure to write the answers. Okay. Okay then. Hope you understand the session. Okay then. Let's wind up the session for today. Then meet you in the next class.